We'll be examining some leading headlines from around the world today. John Nadler joins me next. John, is that really you?
Good morning, Daniela.
Long time no see, John.
How have you been?
Definitely lots to catch up on, John. Let's start by focusing in on the U.S. Black Friday online sales topping US $1 billion for the first time. Are we headed also to record retail sales for Q4? I guess my question to you is, are we on a string of luck for the U.S. economy? Are these all signs pointing to a recovery?
Well, when you look at the fact that almost 250 million Americans, went on a shopping spree during this traditional post-Thanksgiving period, that is indeed a huge number, and it's a giant percentage of the population. So someone out there must be feeling fairly, flush with cash or confident enough. In fact, we saw the string continuing this morning with highest level of U.S. consumer confidence really since the recession began in 2008. So again, that lines up and dovetails with most of these statistics that have been coming our way even before since before the election, namely that durable goods orders are robust, at least unchanged even after Hurricane Sandy. That again, as I mentioned, consumer confidence is at very high levels. Housing seems to be solidly on the mend. And of course, GDP, which probably will come in at about 2%, but could be revised as high as 2.9% for the third quarter. All of these line up in favor of the argument that the U.S. economy is far from, dead or dead in the water. And that dismisses a lot of the previous arguments that, in fact, we might be skirting any kind of a recession. All of this, of course, plays into, markets being a little more buoyant.
So I spoke to some analysts recently, John, including Paul Van Eden, who's quite bullish on the U.S. economy, and he was saying how that might hurt gold prices. So my question to you is, A, is an economic recovery in the U.S. hurtful to gold? And B, should we not also look at gold in a global context?
Well, we always do look at gold globally because it's, of course, a function of the ebb and flow of demand from various regions across the world, specifically India and China, which have been playing such a large role over the last 3 and 4 years in the physical offtake section for gold. Of course, on the production side, we have South Africa, which we need to keep a continuing eye on because of difficulties in output. So in general terms, of course, regionally speaking, this could play into some weakness on the gold price side if, in fact, the dollar takes off towards significantly higher levels, say 82 or 84 on the trade-weighted index, on the back of these solid economic metrics from the U.S. and on the fact that potentially a newly installed Treasury secretary could come and bolster the dollar with not just jawboning about it, but actually doing something, material about its value. At the end of the day, I think what happened here was that the U.S. went into the vortex of contraction first, and of course it is coming out of it first as well, while the rest of the world, namely Europe, continues to have difficulties, and China is still a question mark in terms of its ability to stop a more significant slowdown. So we have to keep a global eye on this.
Right. Well, that was my point. Even though there is or could be signs of a recovery in the U.S., we still have hard times in Europe, China, Japan.
Right. But on the other hand, you have to also consider the fact that nearly 12 years into a rising gold price, there could be a period of perhaps 2 or 3 years of sideways to slightly downward action, and that the average gold price could temper itself perhaps to the level that CPM Group mentioned in the mid-1600s, possibly lower, perhaps not as low as Mr. Van Eden suggested the other day, but still, far away from this moonshot scenario, which is predicated on basically the sky falling and people rushing into gold in massive numbers.
Right, John, but just as you think gold could hit $1,650, $1,600, is it also not plausible that it could hit $2,000 in the first quarter of 2013?
Well, you've seen one projection from one Swiss analyst, which says that if, in fact, we do have a short spike before year's end, possibly to as high as 1950, that could be followed by a retrenchment back into the 1750, 1800 area. Numbers per se don't mean too much to me. As I mentioned earlier, the core watch item here for an individual investor is to try to maintain a consistent allocation in gold, simply as an insurance policy. Whether that centers around the 5% or 10% level for a person, that's obviously a matter of individual preference. Some people like as much as 15%. But in general, diversifying a portfolio by the inclusion of gold, regardless of the expectations for price performance, that's what matters. And in that sense, one should treat it pretty much like central banks treat gold. Have it in the basement.
All right, John, let's change subject now onto the next leading headline. Who would be the best pick for Treasury Secretary? We know Tim Geithner will be stepping down. Will the next person in line be as dollar friendly, and how important is that?
Well, Mr. Geithner has been claiming to be a friend of the dollar, at least in a variety of speeches he has held throughout the years. And, no Treasury Secretary, I think, will go out and say, I'm in favor of a weak dollar or perhaps we'd like to depress the dollar. On the other hand, some of his words were not translated into action, certainly at least as far as the, stance with China goes from the U.S. And now the betting has begun on sort of who will replace Geithner and what type of a Treasury Secretary might we get.
So Warren Buffett has been vocal about his top pick. He suggests J.P. Morgan Chase's CEO Jamie Dimon. What are your thoughts on that?
Yes, Mr. Buffett suggested that, under sort of certain scenarios and under a difficult scenario for the Treasury, that Jamie Dimon might be the best choice to come and, take over the reins at Treasury. This is not something that would be, unprecedented in terms of some people say that the best Treasury Secretary since Mr. Hamilton was probably Mr. Rubin under the Clinton administration. And of course, we know that he came from Goldman. And of course, a lot of people didn't like that idea. But nonetheless, it was an era of substantial strength in the U.S. dollar, not only in terms of what the Treasury overtly said about the dollar, but in terms of action for the dollar and supportive for the dollar. So this could be a very interesting period coming into 2013 and 2014 because we have a convergence of a new Treasury head, probable sort of departure signals from Mr. Bernanke eventually, and of course the whole idea of what will the Fed do to normalize rates and to get away from this ultra easy money policy on which it has been since 2007.
So, John, on this note, I'm curious to know who you would like to see as Treasury Secretary and Fed Chairman. Who are your picks?
If I had to choose, I would choose a person who has been directly involved with, the street, if you like. I'm not suggesting Jamie Dimon per se, but I think there's a lot of bright minds who have been directly involved in the trade of the dollar, who have been involved in financial markets, who understand the economy. And, this is up to the administration to choose the best candidate ultimately. But I think it needs to be a person with direct street experience in that regard, rather than a pure theoretician. No, I think certainly, there'll be a lot of applicants in the pool, but I think ultimately the name will be familiar to all of us.
Okay, John, so you're not giving me a name. That's fine. Let's move on over to India now. Let's look at any reports that you've heard emerging after Diwali wrapped up about 2 weeks ago. What's demand like coming from India?
It's been a mixed bag. Certainly, it's been encouraging to learn that demand in the urban areas went up roughly 10%. The big problem for India remains the fact that the rural areas, which are the backbone of physical demand in that country, traditionally speaking, have been down 20 to 30%, owing to the fact that monsoon season has been quite poor this year, and obviously spare cash is not available as much as it was in previous years, and also to the fact that the officials in India, central bank specifically, are really very keen on trying to curb India's demand appetite for gold. To that length, they instituted all sorts of tariffs and measures this year, which at the end of the day, if you look at the year-on-year demand, the projections are now that India will have imported nearly 5.5 million ounces fewer in terms of gold this year vis-a-vis last year. So it is having an effect. But the season's now come and gone, and we basically have to look forward to Chinese New Year to hope to revive physical demand in that part of the world in general.
Right. Just want to interrupt you there, John. When I was speaking to CPM senior analyst Rohit Savant, he informed me that he was seeing an increased buying of ETFs over in India, which I found interesting.
Yeah, and this is part of the government's efforts to try to divert some of the demand that has been pouring into physical metal into paper versions of gold, if you like, so that there's some sticky money, not under the mattress money. But this whole idea of the investment niche having to support gold prices is very critical. And I would, as I said, put forth my own argument, which is now that we've watched India and China, let's watch what happens on the hedge fund and money manager side of this equation, because the surplus in this gold market is sizable enough that we need continued, daily demand on the order of $500 million worth from this sector in order to just clear the surplus in the market and maintain prices just where they are. And that's a sizable number, $500 million per day.
John, I could talk to you forever, but unfortunately our time has come to an end. I'd like to thank you for joining me, especially after such a long hiatus. Thank you.
You're welcome, and we'll see you shortly.
Thanks, John. And you can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.